This is Never Close the Inquiry with Nick Hagan. Welcome to Never Close the Inquiry, where I aim to demystify the right for the left and the left for the right, where if you come as a conservative, I want you to leave knowing a little bit more about liberals. And if you come as a liberal, I want you to leave knowing a little bit more about conservatives, with the whole idea that over time we'll create better conversations, better relationships, better arguments, and maybe 80 or 90 more steps down the road, a better country. All right. This is my interview with Professor Paul Mahoney of the University of Virginia School of Law, which, of course, is my alma mater. Professor Mahoney has been at UVA since 1990. He was the dean from 2008 to 2016. So he was the dean when I got there, and I never took a class from him. But his area of expertise is securities regulation. And he, in 2015, published a book called Wasting a Crisis, Why Securities Regulation Fails. And I knew that Professor Mahoney, he had a reputation as this great conservative scholar who was skeptical of government intervention in the markets. And I remember, when I graduated, my parents came into town, everything like that. I'm in the bookstore, just kind of, this is going to be one of my last times in the UVA bookstore. Well, I actually stayed in Charlottesville to study for the bar, so it wasn't. But anyway, I was thinking at the time it could have been. See this book on the shelf, and I buy it. And then it sits on my shelf for years until recently I interviewed Professor Mehrsa Baradaran of the UC Irvine School of Law about her book, The Quiet Coup, Neoliberalism and the Looting of America, which makes a critique of the way the federal government regulates the securities markets from the left. And so here I have, this great book and this, brilliant professor on the podcast speaking about these things, coming at them from the left. And I thought, you know what? It would be pretty cool to get someone who can speak about them from the right. So I pulled the book off my shelf, read it, emailed Professor Mahoney, got him to come on, and we talked about it. And the really interesting thing is that there does seem to be a fair amount of agreement between the left and the right about what actually happened, where the federal government kind of split the difference between, the right and the left, and really, help, the banks and these insiders are really helping craft these regulations, perhaps to the detriment of, not the banks. And so this is that interview. It's coming at the same issues that I talked about with Professor Baradaran. It's coming at a lot of them from the other side of the aisle. And I had a fascinating talk. I had a great time talking to Professor Mahoney. He is a brilliant, brilliant man. And I hope you get something out of it as well. First off, thank you very much for agreeing to speak with me.
My pleasure.
This is really interesting. I've had this book, Wasting a Crisis, I've had it on my bookshelf in New York and now in Salt Lake since I graduated from UVA. I bought it. I think, my parents were in town, for graduation, looking around the bookstore. And finally, now that I'm leaving law school, it's like, I'll read class stuff outside of class
Sure.
and so I bought it and then never read it. And, started and then just doing other things. And then at the firm. So wasn't, looking into laws that weren't totally germane to my field of practice. I did bankruptcy law at Skadden
Of
for
course.
6 years. But then I was reading Professor Mehrsa Baradaran's book, Neoliberalism, or The Quiet Coup, against neoliberalism. Recently, I was like, you know what? I think I've got a book that might provide an interesting counter argument to the arguments she's making. And so pulled out Wasting a Crisis. And though I think much of it is not intended for a non-sophisticated audience, like even for myself, I'm not well versed in quantitative methods, anything like that. The middle, the middle of the book, much of the math I'm following ish, but I couldn't replicate it comfortably.
Right.
But I would love to get your statement of the thesis of yeah, I was going to how would you define the thesis of the book?
So, the thesis of the book is that often regulations that are put in place with the goal of protecting some vulnerable group, consumers, investors, whatever, ends up actually being shaped by the regulated industry. And it's ultimately solves a problem that the regulated industry has, which often is simply that they're facing competition from
Mhm.
someone else and they want to reduce the amount of competition. And so they end up inserting themselves into the legislative or regulatory process. And they ultimately get what they want. Maybe not
Mhm.
everything, but they get some of what they want out of that process. And the purported beneficiaries then suffer as a consequence. Now, that's of course not to say that all regulation is always bad. It just means that we can't simply look at the reason for a regulation and assume that that's what's going to happen. We have to look at it carefully. And a lot of what the book tries to do is to just say, let's look at the facts. Let's look at the actual outcomes and let's see whether this was good for investors or not good for investors.
Yeah. And so the way you try to show that that's a really interesting way to put that because frankly I think much of what you said, much of that thesis would be accepted by a lot of thinkers on the political right and a lot on the political left. That is not a yeah, that's certainly not a fringe view. And would it be fair to describe that to some degree as, or would it be fair to call that regulatory capture or a version of it or related to it?
It is related to it, yes.
Okay.
Regulatory capture, I think, often talks about the close interrelationships between a regulated industry and the regulatory agency itself.
Right.
I'm talking about maybe a broader concept, which is that the industry can help shape legislation, it can help shape rules, it can help shape the way that those rules are enforced. But I want to go back to the point you made. I, I think it is a fairly fundamental assumption underlying progressive politics and even populist right wing politics that government power helps, in a sense, even the scale. It helps
Hmm.
consumers push back against big business. It helps the poor push back against the wealthy, and so on. And one of the messages of my book, although of course it has a fairly narrow focus on securities markets, but one of the messages is that the government actually can and often does work in the opposite direction. That we can't be confident that as government gets bigger and more powerful, the big winners are always the sort of least powerful elements of society. Often they're going to be the most powerful elements of society. I think actually that's a really fundamental question of our politics is does bigger government ultimately help the people that it says it wants to help, or is that not really true?
So, and that's very interesting. Why would you say that is? Because we can say big government, but a big government in and of itself, that's not necessarily that descriptive. I
Yeah,
think it comes down at least to some degree to what the government is doing and not doing.
yeah.
So, what? Yeah. Any thoughts on that?
Well, so a lot of the pressure for government to do more is there's some problem somewhere.
Hmm.
And there are many ways that one might solve the problem, but one way is just to throw it in the lap of a legislature or a regulatory agency and say, here, you solve it. And one thing that's interesting about my field of study, securities regulation, is how clear it is that the impetus for new regulations is virtually always a downturn in the stock market.
Right.
When there's a big decline in equity prices, whether that happens in 1929, whether it happens in 2008, whether it happens in 2001, there's always an immediate cry that we need to do something about this.
Hmm.
And governments respond to public anger, and when the public is angry at stock markets, there's this very odd phenomenon, which is, on the one hand, politicians can achieve their goals by demonizing the securities industry, but
Hmm.
the securities industry can achieve its goals by not actually fighting back, but instead working behind the scenes to shape the resulting regulations.
Right. That yeah. Okay, eh, that's interesting. The from the introduction to your book, because I do think, it's careful to emphasize, or it's important to emphasize that you are not necessarily opposed to all regulation. This
Oh,
isn't
not at
an
all.
yeah, it's not an anarchic approach or whatever that would be. From the introduction, you say logically, regulation can have three different effects in varying combinations. It can benefit society by solving informational or incentive problems that keep markets from functioning effectively. I'd like to get back to that in a second. It creates social costs because complying with regulations takes money and effort. And having spent, I can say, I know, and actually it'd be interesting to get a little bit more on your background. I believe, were you at Sullivan and Cromwell after your clerkships?
Yes, I was. Right.
Okay. I haven't looked that up in about a decade. But it creates basically the point that this idea of it creating social costs because complying with regulations takes money and effort. That is absolutely true. Anyone that's been at a big law firm will tell you. I mean, the amount of money that goes to lawyers to help companies, and it's large companies that can pay these bills, comply with federal regulations is astounding. It's and it, having worked on a number of 10Ks and other filing documents, even from a bankruptcy perspective, we're commenting on some a more narrow section of what is going into this, but still, it's not clear how much you're actually benefiting the public with a lot of this. Certainly benefiting ourselves. Made quite a lot of money doing that. But and then finally, it creates private benefits because compliance costs are not uniform across firms, which I think gets to your point that the more regulations you introduce and the more that companies have to do to comply with them, the more it favors the firms whose existing practices are closer to what the regulations require.
Exactly.
And then also it favors those who have the money to pay for it, who can absorb these increased costs.
Right. Just so, yes.
Okay. Do you have Can you think of it like a practical example from when they were putting the Securities Act, the Exchange Act into place that would illustrate that?
Well, so one of the things that I talk about in the book is the fact that the initial design of the securities laws, and indeed still the major design feature of the securities laws, is disclosure, right? We've all
Right.
heard the sunshine is the best disinfectant, et cetera.
Right.
So the idea was when companies sell securities to the public, they're supposed to make disclosures, financial and narrative about their business and operations and so on. And if you look at the statute that achieves that, which was enacted in 1933, it has the basic principle that companies have to make these disclosures, but it has an enormous amount of ancillary provisions.
Right.
And those actually, in many ways, are more about secrecy than they are about disclosure. They tell a company that's offering securities to the public, you can't speak at certain times or you can't say certain things. and in a way, I always found that very puzzling. And I really wanted to understand, why is that so? And there's a simple answer. The major investment banks wanted it that way, and they had a lot of influence in the legislative process. And the reason they wanted it that way is that during the 1920s, the largest and most prestigious investment banks faced growing competition from a number of upstarts that simply innovated. They had new ways of doing things, and in particular, just faster ways of moving securities from the issuing company into the hands of investors. And that was very disruptive to the existing business model of the sort of old line prestige, if we want to call it white shoe investment banks. And
Hmm.
they fought back through the legislative process and ultimately succeeded in outlawing many of the practices that the innovators used.
Hmm.
And that's, I think, there are sort of three things in general that regulation can do for an industry that can be very beneficial to it. It can limit new entry into the industry,
Hmm.
it can fix prices, and it can suppress innovations. And I try to give examples of all three of those in the book, and I've just given you an example of the third.
Hmm. Yeah. So that's it's interesting. So let me before we continue, let me get a sense, because part of this effort, part of the newsletter, part of the podcast, I want people not to just understand and think about what they think and should think now, but understand how they got to that point in the first place.
Yeah,
So you and it's, I think, particularly germane, considering that this book is very heavy on quantitative methods. The full middle of it. This is a mathematical, statistical analysis of the impact of security of the regulations there in the laws and regulations there in the Securities Act, Exchange Act, seeing and Investment Company Act, seeing what impact those had in the industries those purported to regulate. So so my understanding of your background, you went to MIT for undergrad.
right.
What did you study there?
Electrical engineering.
Okay, so classic path to law school. That's what everyone does.
Right, right,
Yeah.
exactly.
So you're at MIT. You do electrical engineering. At what point did you decide? You know what? I think I'm going to be a lawyer.
When I worked over the summers doing electrical engineering work, I thought, gee, I really enjoy my classes, but the work, it just doesn't it doesn't really grab me.
Hmm.
It's just not fulfilling
Yeah.
to me. And I think what I concluded was that I was ultimately more interested in human institutions than in physical structures.
Interesting. Okay, and so then totally makes
But you
sense.
can use the same mathematical techniques to study both.
Right. Right. And so you go to Yale for law school. And did you start? Were you first introduced to kind of the field of law and economics while there? Is that something
Yes.
that came later? Okay.
Yes, that was something I had no idea that there was any such thing as law and economics
Right.
until I walked into my small section of contracts with the late George Priest, who just recently passed away. Just one of the most interesting, brilliant, and personable professors you would ever care to meet. He taught contracts through a law and economics lens. And that
Mhm.
just really opened up a whole new way of thinking about the world for me.
From for the benefit of the non-lawyers that listen to this, how would you define the field of law and economics?
I would define it as asking questions not just about what's fair, but asking questions about what incentives do rules create and how do we think people will respond to those incentives?
Hmm. Hmm. There's a lot there. Okay, and so then you leave Yale and you clerk for Judge Winter on the Second Circuit.
Who was also, by the way, a foremost practitioner of law and economics.
Right.
He was also very influential first of all, he was the one who convinced me that securities regulation was interesting, which was something that had never occurred to me previously. So I owe my field of study to him,
Uh-huh.
just as I owe my methodology to George Priest.
Got it. And then, but then you leave Judge Winter and you go to Justice Thurgood Marshall,
Right.
who I don't know to be a law and economics inclined justice, although maybe you can correct me.
Well, here's what I think a lot of people don't realize about Marshall. He was
Hmm.
very interested in business and corporate law and so on, because remember that he served on the Second Circuit before he served on the Supreme Court. The Second Circuit is the most important court for corporate and securities law in the federal system. Uh,
Hmm.
and he became somewhat familiar with that area of law and found it intellectually interesting.
Hmm. Got it. Okay. So, and then you go to Sullivan and Cromwell. You spend a few years there, and then you go into and then you start teaching.
Right.
How has your personal view on these issues evolved over the years, if it has, and if it hasn't, what gave rise to it in the first place?
So I think the I would say the evolution was I started off just accepting most of the assumptions that I was exposed to in college about how markets on their own generate lots of problems, lots of unfair, unsafe outcomes. And of course, we need a lot of government regulation to solve those. I
Mhm.
think during the course of law school, with the uh, education I got from a number of prominent law and economics scholars, I maybe flipped a little bit to the opposite extreme and got to the point of maybe thinking that regulation usually was wrong-headed. And now I think because I really became determined to look at things not from the perspective of what is this supposed to be doing, but instead, what does it actually achieve? I've probably landed a little bit in the middle. There are some regulations that I look at and I try to measure their effect, and I say, yeah, it looks like this is actually achieving something good. And then there are some that I look at and try to measure the effect, and I say, yeah, this is not very effective.
Yeah. That's funny, that reminds me, so I'm very open about my bias in my newsletter. I'm trying to talk to everybody, and I think it's important to challenge your own views and all that. My personal bias, my heart, I have a liberal heart. And that's where I start from it. And I bel my heart believes in the idea that the government can fix it, and that, all that. But then if you look at a specific regulation or a specific set of laws, I don't know if it's more often than not, but certainly very often I'm able to look at it and think like, that's not gonna do what you think it's gonna do. And so it's like, I love the idea of regulations and laws, but not those regulations and laws.
Right, right,
And I and, to this idea that there are often unintended consequences, uh, to legal reform, I Professor Vollmer would talk about this a lot. Th I don't recall the exact year, but in the early '90s, the SEC, they changed some law or regulation with respect to executive compensation. They're required, now companies have to disclose what they're paying their executives, and And it's like, well, to Justice Brandeis's idea that sunlight is the best disinfectant, it's like, these guys are making away like bandits, behind the scenes, and, we gotta get this out, to the public, and then they will be shamed by the fact that, you're putting out your 25, 30 million or whatever compensation in front of the public, and you'll start giving more of that money to your employees. And then in reality, what happened was now all of these executives knew what their counterparts at their competitors were making.
Right.
It's like now you got to, the starting point for their negotiations just went way up because no, you're not going to come in and say you don't want to make less than the average person in your analogous position in your industry.
Exactly. Everybody's above average.
Right. Yeah. And then when everybody's above average over time, it just keeps going up and up and up. So you wrote your book in the aftermath of Dodd-Frank. And Dodd-Frank came about as a result or in reaction to the financial crisis. What would it wasn't entirely clear to me. Are there any reforms that you would have or what reforms would you have instituted or thought more prudent to institute in the wake of the financial crisis?
So I think the basic idea of requiring banks to hold more capital against their assets, in other words, to reduce the relative mix of stockholders' money and borrowed money in favor of more stockholders' money and less borrowed money. I think that's a good idea. And
Okay.
Dodd-Frank did that, and it probably should have done that. That's a few pages out of many hundreds of pages of Dodd-Frank. And I think, once again, a lot of the ancillary provisions seem to me just absolute recipes for unintended consequences.
Any interesting. Do you have any specific examples of something you think like that's not going to work or it's going to
You
do
know,
something bad?
so I think we have to back up for a moment and note that, unlike, say, during the Great Depression, when Congress would write a specific statute to deal with a specific problem, because of the polarization that we see in Congress these days, when you get that rare window that opens when there's agreement that something needs to be done, there's this massive rush for everybody who's got some provision that they want to get it into the bill, no matter how related or unrelated it is to the nominal purpose of the bill. So,
Mhm.
there are lots of things one could pick in Dodd Frank, but one of my favorites is that there, and I don't know who was the moving force behind this, or I should say, I don't remember who was the moving force behind this, but there's a provision that says, well, the SEC should require more disclosure about the use of conflict minerals in a company's supply chain because there's war going on in the Congo, and there are armed groups that are financing their arms purchases through uh, extracting minerals,
Mhm.
basically from the people who are mining them and just more or less stealing them. And we think by forcing U.S. companies to disclose what they're doing with their supply chains, that will sort of drive these conflict minerals out of supply chains, and it will cut off financing to these armed groups. Now, uh, cutting off financing to armed groups, yeah, I mean, I'm all for that. How likely is it that this is going to work? Well, I think what happened is exactly what anyone who thought about it would have predicted, which is it's very hard if you're buying a particular type of metal to determine, well, did this come from mine number A or mine number B? And so what happened? Well, the companies just started sourcing from non-Congolese sources. So you ended up hurting many of the people that the statute nominally was out to help.
Hmm. That yeah. I would also note that as noble as that aim is, as not providing finance into these armed groups, and maybe you do want American investors, largely we're talking about institutional investors mostly, to know, that if they want to invest ethically according to their own uh,
Right.
views, like giving them more information to do that isn't necessarily a bad thing. But it also, like, that regulation that has nothing to do with what caused the crash. That's not a
No,
response to
nothing,
any of that.
nothing whatsoever. It is a response to the fact that everybody viewed this as a must pass bill, and
Right.
therefore, whatever you've got, throw it in.
Yeah. Loaded question. I have two questions. So the first, this is borrowing from uh, Professor Baradaran's book. She makes the claim that there were no banking crises between the New Deal reform era and then once neoliberal influences started to come into play, and certain restrictions had been removed on what banks could do, where they could lend, where they could set up branches, and all that. Uh, there's not a lot of detail that I just gave you right there, but how would you respond to that?
Well, she's absolutely right about the basic timeline. So we have this structure set up after World War II, and there really are no financial crises from that point up until really into the 1980s.
Yeah,
And then the question, and it is also the case that there were certain restrictions on bank activities that were loosened beginning in the 1970s. So the question is that causal, or is it coincidence, or is there something else going on?
yeah,
And I would just note that there are an awful lot of other things going on. One thing that is a real source of financial crises is macroeconomic instability. By that I mean interest rates, inflation rates, etc. Well, if you look at those things from World War II up to the 1970s, essentially from 1949 until the early 70s, interest rates are incredibly stable. Inflation rates are incredibly stable. So, what is going to cause a financial crisis? There's none of the typical triggers for a crisis are occurring within the economy. Well, we all know what happens in the 1970s. Inflation just gets completely out of control
yeah,
by the end of the decade. Interest rates become incredibly volatile. So, of course, you've got more financial crises. I don't need any more complicated an explanation than that uh,
yeah.
to describe what happened.
And so that's interesting. And coming from, what Democrats would argue, and this is one thing that's, I think, funny about talking about politics generally, politics and policy generally, and is great about your book. So, your book takes a very narrow empirical focus and then analogizes from that to make some broader conclusions about reform generally.
Right.
Like the data in your book is focused on the 33 Act, 34 Act, and a little bit less, I think, on the ICA a bit at the end.
Yeah.
Um, and then you extrapolate from that to talk about other reforms. Uh, much of but a lot of what we talk about in politics, like our observations made from 35,000 feet of incredibly complex systems, and we're establishing cause where either there is none, or the cause we can't explain, or even if we get it kind of close to right, we're missing some major stuff. And so, what liberals argue is that this period of, stasis that you describe following World War II can be directly traced to New Deal era reforms, and that it starts to fall apart in the early '70s because that's what Nixon comes in, wins. It didn't have a majority in Congress, but it just smashed everyone at the Electoral College, especially in '72. It has weight behind him, and you really start to see a lot of change and some loosening. Alan Greenspan has a big impact. Uh, what would if that's the basis of the argument, and it is kind of a 35,000 feet argument, what would your response to that be?
Well, I think my response once again is I think that the causation actually there is backwards. What happens is that by the 1970s, you've got all of this macroeconomic instability. The
Mhm,
U.S. is suddenly, um, running larger deficits. We've got a lot more inflation. We've got a lot of interest rate instability, and suddenly banks are there saying, we can't operate in this environment in a world where you're telling us, remember, at that point, the government is setting the interest rate they can pay on deposits. The
right.
government is putting all sorts of restrictions on uh, how they can earn their money. And those restrictions were perfectly fine. In fact, the banks loved them in the good old days when the interest rates were 5%. They were paying 2% on their on their deposits, and it was truly a wonderful life.
Mhm,
At that point, they had a very steady and non-volatile source of earnings, and then suddenly in the 1970s, they just don't have that anymore. And so, of
mhm,
course, they run to the regulators and say, "You got to loosen some of this up, or we're all going to go bankrupt." So the
mhm.
causation, I think, actually runs in the opposite direction. It's not that it was the changes in what banks could do that caused the instability. It was the instability that caused the changes in what banks were allowed to do.
Got it. Okay, so it's not the theoreticians, that are there, in have government power and are like, the banks are happy, consumers are happy, but we're not happy. We're changing it. It's that macroeconomic changes prompts the bankers and whatnot to go, okay, to the government. That makes sense. The I'm sure there are some that argue with it, but that makes sense.
Yeah.
The with the Okay, so turning now to where we're at now, is that there are some very interesting things happening with the current administration and just current macroeconomic environment and various. So as I was reading the book, I kept thinking about two things that we see a lot of now. One, crypto has become a big thing, and crypto. I'm sure some on the internet would dispute this, but I think crypto related fraud is a very big thing, and it is certainly I don't know. It seems like there's fraud connected to a ton of it. Is this something where you view that, or you think that the government should step in, should consider stepping in, or where over time the market will kind of correct itself and people will uh, stop irrationally investing in something and get the rug pulled out from under them?
So I think there are a lot of moving pieces in that question. So
Yeah, sorry.
let me try to pick out a few of them. So
Okay.
one basic issue is that it's just not clear how crypto fits into various existing regulatory schemes.
Right.
Which crypto assets count as currencies, which count as securities, which count as commodities. I think the government absolutely should step in and clarify those things. One problem that I think is quite common when you have that kind of uncertainty is that the financial institutions that have a lot of reputational capital that they could lose will stay out of a market if it's possible that if they get in, they'll be found to be engaging in some kind of regulatory violation. That's just not good for their reputation, so they stay away. And instead, you get people who are somewhat more, shall we say, on the fringe of the financial system, who are involved in the markets, and they may have less reputational capital built up that they can lose.
Hmm.
Um, so that's one issue. A completely separate issue, and I just don't know what to do about this. I'm not sure that I really understand it. Is that there seems to be a growing desire among parts of the populace to just take huge and I think very not smart gambles.
Hmm.
You see it, right? You see it in sports gambling.
Right.
You see it in meme stocks. You see it in meme coins. I'm not sure what to make of it. I mean, certainly I look at many of these things and say no one in their right mind would be involved in this investment. And yet there are many people who are. So maybe they're wrong, maybe I'm wrong. We'll find out.
Yeah. 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 I tend to lean your direction. I think they're probably wrong. But yeah, man, that is tough. It's a tough issue. The Is there anything that you would do to reverse some of the negative effects of past regulation? Because what we've seen, let's just to kind of broaden the scope, over time, we've seen a consolidation in these industries. Obviously the banks now, you have far more of these banks, or well, you have fewer banks, but they're too big to fail. You have the massive financial institutions that just dominate and crowd out any possible upstart competitors. And it's not just in finance, although it certainly is very much the case there. Uh, and and I think I completely agree with you that a fair amount of that consolidation and then the corresponding negative effect on competition has come about because the regulations have facilitated it. Is there a way to turn back the clock?
Well, yes, I don't know that turn back the clock is necessarily the term I would use, but what I would say, and I'm really going to focus on the Securities and Exchange Commission
Sure.
because that's what I know best. I would call it a sort of back to basics approach. I think that the Securities and Exchange Commission was designed to be a disclosure regulator. I think it does its best work when it focuses on basic financial disclosures about publicly traded companies. And a lot of its forays out of that area, whether it's regulating the entire structure of the equity markets in the United States, as it increasingly does, or trying to get out of financial disclosures into things like climate. I think
Hmm.
those have tended to not be as successful. And so, if I were advising the commissioners of the Securities and Exchange Commission, I would say, why don't you focus on your core mission? Because that's a good core mission,
Hmm.
and it's something government ought to do, and you're actually good at it. And just accept that no, your job isn't to save the world. It's this kind of important but nevertheless narrow piece.
Yeah. Lift where you stand, as the saying could
Yes.
be. The Okay, so let's say that you get an audience with the SEC, which I imagine you actually much more likely to get than I am. And they listen to you, like, you know what, you're absolutely right. That's a great idea. We're going to focus on that. or do that. What do you see the impact of that being? Because on its own, that doesn't seem like something that would, introduce uh, a material or would lead to a material increase in competition on Wall Street, for example.
Well, it could
Okay.
actually,
Okay.
because, for example, one of the I alluded to the fact that the SEC has um, written quite extensive rules about how um, orders have to be executed and routed within the equity markets. Um,
Mhm.
I think that's actually something that the markets themselves are perfectly able to solve. And
Mhm.
I think you would see competition among varying ways of bringing buyers and sellers together. Now, you do have some of that today because you have these so called alternative trading systems that don't qualify as exchanges. And they do a little bit of innovation. But I think if you just open up the exchange space to innovators, I think it's entirely possible that costs would decline, and it, at a minimum, compliance costs would decline. I mean, fortunately for a typical investor these days, um, participating in the equity markets isn't very expensive. Uh,
Mhm.
it can be a little more complicated for the institutions who need to trade in large amounts. They have to spend a lot of effort trying to make sure that they get the best possible execution. And I think there's room for innovation in that space. And I fear that maybe the regulations are suppressing innovations that could be quite valuable.
Hmm. Interesting. It's gonna sound funny. That reminded me of two other questions I had. So the first one is going to relate to now, and then the second one is just a mechanical question about what was happening in the 30s. So the first one, this is not an exchange, but is related to this idea of competition. You note in the book that the accounting firms, there's been significant consolidation in accounting
Yeah.
over the last number of years. What was once the Big Eight. My mother was an accountant. She worked at a couple of the Big Eight firms back in the 80s and 90s, and uh, then now it's the Big Four. And I can say, in my time at Skadden, we never used any firms that were outside the Big Four. And what my thinking about it to date has primarily focused, because I was an associate, I was an employee, I was thinking about the people, my friends and counterparts at these firms that were, just young accountants, uh, because within the law firm space, there is really significant competition between the firms. None of the firms are really very big.
Right.
Even the really huge ones, you might only have a few thousand attorneys, and whereas you look at these big four firms, and they have a couple 100,000 employees. And one consequence of that has been that the law firms compete really hard for labor in their associates, and they pay much higher salaries than the accounting firms do to young accountants. I have not thought about the impact at the macro level, with the business. And I'm not even really sure if I have a question here. Maybe I just wanted to bring that up. But do you have can you explain what the like why did the accounting firms consolidate? How what government action led to that?
Well, I don't know that I have a complete answer to that question. I will
Okay.
just say that after the dot-com crash of
Mm,
the early part of this century, the regulation of the auditing function passed from a professional body managed by the accounting profession itself into the company accounting oversight board, which was created by the Dodd-Frank Act. And the SEC requires that any financial statements that are filed with it be audited in accordance with the standards set by the PCAOB.
Hmm.
And certainly we can observe that some of the consolidation starts after that. That's not quite the same thing as saying that we can prove that that's what caused it, but
Hmm.
certainly from a temporal point of view, the consolidation sort of accelerates after that point in time. And as lawyers, we tend to be focused much more on accounting presentation, on what the balance sheet and income statement and so on look like.
Hmm.
But of course, the accountants themselves have to be very focused on auditing standards. How am I supposed to check these financial statements and assure myself that I can opine that they reflect fairly the financial position and results of operations of the company, and that's very heavily regulated now. And you look at the large accounting firms, and they need to comply with those standards really all over the world, because you never know when your client in Tokyo or Frankfurt or wherever it is going to want to get a listing in the United States or sell securities in the United States.
Hmm. Interesting. I know I say that word a lot, but it's true. The next question, completely unrelated. So nowadays, it seems like, now, granted that people make, I think, a lot of investments that are not tied to the quote unquote fundamentals. That with meme stocks, GameStop, that whole thing, and then obviously with crypto, what people are putting their money in, it does not necessarily tie to a company's true value, if we can call it that. But I think because of the internet, there is, it seems like there is just a fair amount of transparency today naturally. Certainly more so than there was before the internet. Um, the focus of your book is on the reforms that took place during the Great Depression. Mechanically, what did things look like then? Like literally, how were they executing trades? Obviously, now you can do it; it's through the internet. And how were investors learning about the companies that they were trading in? Where are they getting the information?
So mechanically, what happened is you contacted your broker. Maybe you did that in person. If you worked downtown and your broker worked downtown, uh, maybe you did it by the relatively new technology of the telephone. Maybe you did it even by letter if you were not if you were out of town. But in any event, you instructed your broker what you wanted to buy or sell. The broker went to the floor of the stock exchange, went to a trading post where there was a specialist for that stock, and the broker could leave your order with that specialist. And then if there was a counterside offer, that is to say, you wanted to buy, somebody wanted to sell, they could match those orders together, or the specialist might trade against that order himself. So essentially, it was just a standard floor trading kind of technology.
Hmm.
Now, where were the where were these customers getting their information? Well, I have actually sitting in my office a bunch of bound Moody's industrial manuals from the 1920s. They're quite remarkable. Many
Hmm.
thousands of pages of analysis of companies. They've got
Mhm.
financial information, they've got narrative information about the company, they've got how many shares are outstanding, who are the officers and directors of the company, when was the company founded, all that sort of thing. So the idea that investors knew nothing about the companies that they were investing in is just not correct.
Hmm. No kidding. And so that's interesting. Kind of to that point, and to your point about the telephone. It seems like one reason there naturally would have been a fair amount of consolidation over time and a focus, on stock exchanges that are based in New York and London and Singapore and major financial markets is that, if we go back 100 years and I'm sitting, right now I'm sitting in Salt Lake City, you're sitting in Charlottesville, neither of our ability to invest in New York based firms would have been much more limited than it is today.
Yes.
And so you have a local exchange, you're trading in primarily local companies, I would imagine. It
Right.
is and then over time as technology improves and investment opportunities open up, that changes and the stronger New York and London exchanges might just win out in fair competition and absorb the smaller exchanges.
Exactly.
Okay. So that's a fair statement of what one reason that some of this might have happened.
Oh, yes, absolutely. I think
Okay.
technology is an important part of consolidation among the exchanges. Now, I think the regulatory system um, certainly had something to do with the timing. I mean, one
Mhm.
thing that you observe is that immediately before the securities laws of the 1930s go into effect, you have quite a large number of regional exchanges in the United States. And it's not like that just decreases gradually over time. It sort of falls off a
Right.
cliff right after the securities laws. Now, I think one could fairly say that was going to happen anyway,
Yeah.
but I think you can't explain the timing simply by saying, "Oh, well, it's the telephone."
Yeah, interesting. That makes sense. It was kind of interesting to think back, to what degree did the federal government's intervention impact the development of certain cities? Because I like at this point in the United States, that the exchanges are in New York, to the best of
Right.
my knowledge. I know Chicago had a big exchange for a long time. I no
Well,
longer.
and they're still, and of course, Chicago still, for largely historical reasons, has the major derivatives markets. And that includes some of the derivatives markets in large stock indexes like the S&P 500. And of course,
Mhm.
that's one of the reasons that there's been such an emphasis on getting the most rapid possible forms of communication between Chicago and New York to shave a few milliseconds or even microseconds off the amount of time that it takes to
Yeah.
send an order from one market to another.
That's interesting. That oof, yeah, it'll be at some point. I hope to do write a newsletter or do an episode just to explain mechanically how all of it works, how trading works, how the stock market works, because I think there are a lot of people who have not gone to law school and sat in Professor Hines' corporate finance class and learned about the random walk theory and all these other
Right.
things that think, you know what, I'm going to invest, I'm going to pick the right companies, I'm going to beat these big institutional investors. And there are just so many reasons, both theoretical and practical, that's going to be incredibly hard to do.
Just so.
Um, so wanted to close with this. Just want to return to the thesis. If we can kind of end on that note, uh, just this idea that while regulation is not inherently bad, and there are certainly positive and helpful regulations, that often the chance to regulate or the chance to pass new laws arises in the wake of something bad happens, and legislators like all right, we're certainly not going to admit it's our fault, that it was a policy failure or anything like that. And now we have all the momentum. We're going to do something. And to an extent, maybe you could say it's a combination of one, a lack of legislative humility in thinking that, not only do we have this fully pegged, what happened and why it happened, but we know how to fix it and keep it from happening again. But then also, oh shoot, I might have lost it. But basically, this wasn't our fault in the first place.
Right, right.
And if you could just end with your thoughts on those 2 points. One, that regulation isn't necessarily bad, but Congress people are not experts, and even experts are going to get this wrong a lot. And frankly, the experts they bring in to inform them tend to be interested experts, I think.
Right.
At least sometimes. Just final thoughts on that, and then I'll let you go.
Well, I think often the hearings that happen in Congress after a financial downturn are really intended as a hunt for scapegoats. So you march in some bankers or uh, whoever, and you try to essentially get them to admit that the whole thing was their fault. I think if one were trying to do this in a genuinely publicly interested way, I think the first question you would ask is, well, why didn't the existing regulations stop this? And what have we learned about our own limitations from this episode?
Yeah. That is not often the question they do ask.
No,
But
indeed.
well, with that, I think that's a great place to end. Professor Mahoney, Dean Mahoney, I really appreciate your time. It was very generous, and I appreciate the book.
Oh, it's been my pleasure. Thank you.
All right, and that was the interview. Thank you very much for listening. If you wouldn't mind, please do leave a review for the podcast. I believe those are important. And subscribe to the newsletter, which will be linked in the show notes, or can be found at neverclosetheinquiry.substack.com. Thanks.